Hi, I'm John King, and I'm here to help you determine, can I landlord? If you're thinking about buying a rental property, you're thinking about becoming a landlord, or you're thinking about growing your portfolio, you're in the right place. Today, I want to talk to you about the 3 investment strategies that most lenders are not going to tell you about. Most lenders simply have 1 or 2 loan options, and they say, hey, you want to buy an investment property? No problem. We've got the conventional loan. Do you want to put 20% down or 30% down? But there's lots of strategies that you can utilize, and I want to be your strategic guide. I'm going to start by walking you through these 3 things that most lenders are not going to tell you. First and foremost, if you are owning a primary home right now, that is actually your best place to leverage taking off to buy your first rental property. Many people who are aspiring to become landlords, they've owned their primary home, they've seen a good amount of equity appreciation, and they're saying, you know what? I actually want to buy something else, and so I'd like to convert my current home into a rental property. That's a fantastic option, provided your home is good for being a rental. You want to think about things different when it comes to what is a good rental property compared to what is a good primary home. An example is, depending upon who your target tenant is, a home with a pool may be more of a liability than it is a benefit. Now, if you're in a luxury neighborhood or a neighborhood with lots of families, maybe having a pool is something that's going to be attractive and allow you to create higher rent. But understand that's going to create bigger risk, because now as a landlord, you've got a liability in the backyard that you've got to have insurance for, and make sure that you are protected and that you're protecting your assets. Okay, it's a key thing to think about when you're buying an investment property, is understanding the risks, especially the risk of getting sued. So be aware of, hey, this might be a great primary home, but maybe it's a super luxury, very nice home. You just remodeled it, and you're afraid the tenant is going to destroy the property and make it so that it's not in as good a condition as it is right now, and it's going to be harder to sell down the road. But you get huge tax benefits, because you get to, first of all, if you convert your current home into a rental property, current tax law says you can still sell that home anytime in the next 3 years, because the rule says to avoid paying taxes on capital gains up to $250,000 for an individual or $500,000 for a couple, you have to live in the home as your primary home for 2 of the last 5 years. So the minute you convert it to a rental property, you can move out, you can continue getting appreciation, and as long as you sell before the end of 3 years, you're able to not pay any taxes on $250,000 in total gain since the day you bought it, if you're an individual, or $500,000 if you're a married couple. It's a great opportunity to convert your primary home into a rental and buy a new primary home. You get primary interest rates on the new home compared with rental rates, which are even higher. Now, my second strategy is, if you're looking to finance an investment property versus a strategy we just talked about where you're looking to convert your primary home into an investment property, this is a game-changing program that allows for much, much easier qualification. I've actually had many of my clients recently tell me, gosh, John, I wish this was around a long time ago. This program, DSCR, stands for Debt Service Coverage Ratio. What does that mean? DSCR simply means, as long as the debt, your monthly payment for principal and interest, taxes and insurance, is serviced or paid for by the coverage, by the rental income. So that ratio of what percentage of your payments is covered by your rental income. Now, here's a simpler way to look at it. Does the property pay for itself? If the property pays for itself, then a DSCR loan means you do not have to look at your tax returns. I don't care about how much you have in credit card debt or student loans or car payments. I don't care that you're self-employed and that you write off a lot of your income and your profit so you don't pay a lot to the IRS. I don't care if you just changed jobs or in a new industry or recently retired. There is 0 income required to qualify for these loans, and they're not that much more expensive than a traditional conventional loan. Why is that? Because Fannie Mae and Freddie Mac significantly raise the interest rate and cost for traditional conventional loans when you're doing a loan on an investment property. So these DSCR loans have actually not gone up, and they are much less expensive compared to what they used to be. When you think about how much extra, if you know anything about these loans, you would know that they used to be a lot more expensive. You had to pay a lot of extra interest in order to get the relief of proving your income. Not anymore. It's really, really similar interest rates to what you'd pay on a conventional loan. So that's a secret that you want to make sure that you think through. Then the third one is exchanging rental properties. So a 1031 exchange is a tax loophole that allows you to sell an investment property as long as you are putting the money into a new investment property. There's lots of rules on timing, how much money you spend, no money left over, lots of little nuances that you better get right, because if you don't do it right, you end up paying taxes on the profit. But a 1031 exchange is a critical thing to understand as you are looking to grow your real estate portfolio, because it allows you to trade from one property to another. Now, why do you want to do that? Because certain properties at certain markets get you more rent than similar price properties in other markets. Maybe you have a single family home and you're getting frustrated by the fact that, you know what, when a tenant moves out, I'm out of rent for a month or 2 or 3 when I try and replace that tenant with a new one. And maybe I want to exchange it and buy a 5-unit property or a 10-unit property. I go up to 10 units, and you can use the money from the sale of your current rental property to buy another rental property, and you can create more leverage. Maybe you own a piece of bare land that you've been collecting rent on it as a storage place for boats and RVs, and now you want to convert it to residential. You can do that through a 1031 exchange. You just have to make sure that you have a few key people on your side. You have to make sure you have a knowledgeable lender. You have to make sure you have a realtor who understands how to do all of this. You have to make sure that you have an exchange company, an intermediary, because they have to hold the money. If the money touches your hands, it is fully taxable. You don't want to make that mistake. And having a great realtor and a great exchanger can help guide you most of the way. You definitely want to have a good CPA on your side as well to help you navigate these waters. So here's some things that you can do to help you to be able to either grow a portfolio you already have or to start a portfolio. But really, all of this advice is specific to your situation. And so you should see a link down below where you can click either in the description or in the webpage that you're viewing this, and you will see a link to schedule a meeting with me. So go ahead and set up that meeting so we can talk one-on-one. There's no obligation. I'm not going to force you to do anything. I'm just going to educate you and talk through your situation. Feel free to subscribe to my YouTube channel. It's youtube.com/CanILandlord. Just look up Can I Landlord on YouTube and you will find me. And I will be here to help guide you through the process of developing or growing your real estate empire.